Good morning, Ever Dossie with Hancock Mortgage Partners. I am here with James Delmore from the Delmore Agency with Farmers Insurance. So we're getting together today. We're going to have a discussion about insurance, and we're going to hit a wide range of things, whether it be property and casualty or life insurance or individual retirement accounts. Now, James is my go-to for insurance. He has all of my insurance. He's who I call when I have questions. He's who I refer people to when I have questions because of his knowledge and his customer service. So I want to get that out there. I am biased towards James. I think he's the best in the industry, but I wanted to have him on so we can discuss some of this stuff because now people have time to look at it. Insurance is kind of a secondary thought most of the time, but now people have time to think about it. So let's talk about property and casualty and how discounts and stuff like that work. Give us some insight on what you're looking at when somebody shops you for a policy.
No, so I look at coverage. I know a lot of customers out there, they shop by price. So agents have the opportunity to look at actual cash value versus replacement cost. You always want to make sure your replacement cost policies are going to replace all the personal contents. I've actually seen policies out there where they've excluded roof coverage. That kind of surprised me. There's not a lot of policies that do it, but it's there. So just shopping by price is definitely not the way to go. You want to understand your coverage. Every house is unique. My house is different than Everett's house versus Steve's house versus all the houses that we insure. So to sit down and design a policy, there's coverages for sewer and drain. There's coverages for equipment breakdown. There's coverages for the roof. There's so many different coverages out there that you really want to sit down with an agent. It doesn't have to be me. It's just you want to sit down with an agent and design a policy that's going to cover your specific house.
Yeah, so this is one of those that it's kind of take your medicine now so that you'll feel better later.
Absolutely.
Another way to look at it is I was always told in business, never bet on the come. Which means never spend money that hasn't come in yet in business. But on this type of deal, we really need to bet on the come on the negative side when it comes to insurance. We're buying insurance for when something bad happens, then we're covered. So if I go out and I shop only on price and say my roof's not covered, it's excluded. I can tell you right now, I don't know how to read my policy. I don't know what's on there. I have complete faith in you that I'm covered the way I should be. But if I go out and my roof's not covered and something happens, that's a huge expense down the road that I only saved a few dollars on monthly.
Correct.
All right. So how do we look at it? Is it the same on auto? Is auto the same way? Are we looking at those coverages and stuff the same way as we do on a house?
It's similar. So on an auto policy, you want to make sure you have the right liability limits. You want to make sure if I get a car accident and I need to rent a car, is my insurance company going to rent it or do I have an extra car? Do I need roadside assistance? Some insurance companies will pay for medical expenses as far as health insurance. Some won't. Does my health insurance cover my medical cost or do I need it on my auto policy? So there's a lot that goes behind what you need, what you don't need on your auto policy. Sitting down with somebody and designing a policy that meets your needs is just as important on your auto as it is your house.
Absolutely. So let's discuss the liability and explain to us how liability coverage works. So if I'm driving down the road and I hit a car and they're injured, explain to me what my state minimum is on liability coverage and how that works above and beyond the cost on that. And should I have higher coverage on that?
Yeah, so that was one of my biggest eye-openers when I got into the industry is I always thought full coverage meant I'm fully covered, and it's not. Your limit, so that 25 that you'll normally see on a policy, you have 25,000 per person, 50,000 per accident, and then the property damage. A lawyer is going to look at that and say, okay, you have $25,000 of coverage. Well, if you have $80,000 sitting in a 401k and you have $80,000 sitting in equity, a lawyer might not really care about the $25,000 that you have in coverage. So it gets complicated, but they can go after you personally, and they can take the equity out of your house. They can take your retirement account, and they can really affect your retirement. So you want to make sure that your insurance, your liability limits grow with you and your assets. So as you grow in life, you start out as an 18-year-old, you're fine, $25,000 in coverage. You get that equity, you get $30,000 in 401k. Now you want to go to $50,000 in coverage. You want to make sure you're protecting your liquid assets with that dollar amount. At some point, hopefully we all become millionaires. We need $1 million umbrella. It covers everything up to $1 million. And we're driving around, something happens, and we don't have to worry about losing our assets. We have an insurance company that's going to back us.
Awesome. So, I mean, here's what I see when we talk about 25,000 per person. Okay, so if I hit a car and there's two people in it and they need to go to the hospital, $25,000 at the hospital is basically 2 ibuprofens. You know, it's a very quick to go through $25,000 on hospital expense. God forbid that they need any type of major. I'm going to be liable for that if I'm at fault in the accident.
Correct.
Got it. So just to paraphrase what you said, so if I've got $100,000 worth of liquid assets that could be attached in a lawsuit, I want to make sure I have the liability coverage on my policy high enough to do that.
100% correct.
Right. So now how would that translate? I've got a 15-year-old. He's chomping at the bit to drive. You know, he wants to get out on the road and he wants to drive. How does that translate to me as the policyholder, as the person paying the insurance and everything when I add him on? Do I need that same higher coverage on him so that it doesn't come after me, or is he the one that's going to be liable if he gets in an accident?
No, you're his parent, you are liable. So you need more coverage. When my 14-year-old daughter gets to 15, she starts driving, it becomes even more important that not that I can't cause an accident. I'm lucky I have not, but it can. It can happen to any one of us. But yes, to the extent and a teenager, they're starting to learn how to drive, my insurance becomes even more important because she can cause an accident that takes my assets. So I definitely want to make sure my assets are protected up to that dollar amount.
Okay, so basically what I'm taking out of that is my kid's never going to drive till he's 18 and can have his own deal.
The sooner you can separate, and a lot of parents like to keep their kids on their policy because there is a benefit to it as far as multi-car, auto, home. The sooner you can separate that child out of your household, get them on their own, help them pay it. But the sooner you can separate, get your name off the registration, the better.
So we're basically mitigating risk is what we're doing. We're reducing liability on our side by getting the coverage in order to cover that. So, and I think it's important on the kid side because, you know, I'm 42. I've been driving since I was 12. You know, I've got pretty good experience driving and I haven't had a lot of accidents that were my fault. I've got little fender benders, not paying attention. But when I was 15, I rolled 2 trucks. I hit a cow one day being where I wasn't supposed to and totaled the truck. I had several major accidents when I was young because I just didn't have the experience to drive. Now, fortunately for me, I lived in South Dakota in the middle of nowhere, population 3. So I didn't have a lot of accidents with other vehicles that caused liability for my dad. But now living in Albuquerque, in the Albuquerque area, it's a lot more difficult for kids to drive and stay out of those accidents, not cause those. Probably should have had Steve on. His kids have had several accidents and stuff, but we need to make sure that coverage, and we want it to grow with our assets. So,
correct.
Okay. So I think that's a great point. Now let's talk about the coverage on our houses, because I know there is some medical coverage and stuff on homeowners policies and stuff like that. Can you explain to me how that works? Somebody comes over, falls down, gets hurt. How does all that work on my home?
Exactly the same way. So $300,000 is pretty standard in the industry. Not too much happens beyond that, but it can. So you want to make sure that you have enough liability coverage that somebody, you know, you didn't you have a nail sticking up and somebody steps on it, has to go to the hospital. You're liable for that. It's on your property. You didn't take the ice off your sidewalk. A lot of things, slips and falls, can happen on a property that you are responsible for. So it's the same thing. They're going to come after you. You want to make sure you have enough liability on your home policy.
Okay, so now let's say I fall off my roof myself. Does my homeowner's insurance cover that?
No, it's only designed to cover what you're liable for.
Okay.
You can't have coverage on your house for anybody that lives in the house. That's on your own health insurance.
Okay. Now let's say a big storm comes through and the roof caves in and hits me in the head. Will the insurance cover that?
Hits you in the head, there's going to still be your own health insurance.
Okay, so it's still going to go against my own health insurance. The insurance company is not going to take any liability on that as far as paying out.
Correct.
Okay.
It's going to fix the roof.
So what do I need to look at on homeowners insurance? Because I know it gets pretty technical, wind and hail, stuff like that, things that can take place. What is it I need to look at and make sure that I have coverages on?
So it's important to have the right coverage as far as the house. A lot of people think the house should only be insured for what they bought it for. So that always seems to be a conversation. You want to make sure that the house is going to be insured for what it's going to take to rebuild it if something happens. So 2020 materials are going to be different than your house was built in 1960. What it takes to build it with brand new 2020 materials is going to be what you want to insure it for. So you want to make sure you're with an insurance company that's using current reconstruction costs, and you want to make sure that it's insured over current reconstruction costs. So if it takes $110,000 to rebuild a house today and you insure it, you want to make sure that you have a little bit of extra coverage. So we always go 110% to make sure that if inflation happens throughout that year before your policy renews, that you have inflation guard. I don't want a house to burn down. I have it insured at 110,000, but now it takes 120 and my customer doesn't get the same house built. So it's important to make sure that you have extended replacement.
Okay, so now answer this for me. Let's say my house is 200,000. That's what my policy is covered for. And it cost 150 to rebuild it. If the place burns down, does the insurance company just give me 200,000?
No. You're going to hire a contractor. That contractor is going to build you a house, and the insurance company is going to pay that contractor.
Okay, so they're going to pay the actual cost to replace it or rebuild it.
Correct.
Up to my coverage.
Correct.
Okay. So, I think that's a big misnomer. It's something that we see generally on higher end homes. So home's worth 400,000. That's what I'm buying it for. But replacement cost or to rebuild it is 310,000. A lot of people are carrying insurance at 400,000 or 500,000 because that's what they paid it for. So it works opposite also, right? Because I'm not going to get that 400,000 if the house burns down. I'm going to get what it costs to rebuild it.
True. Yeah, you can overinsure yourself at the same time. That is true.
Okay, so my thought process is, and something I think everybody needs to understand on that replacement, if you have a mortgage on that, we're going to want that house rebuilt. So the insurance company is not going to cut a check to that client, that insurance client, in order to say, hey, here's 310,000, get a house built. They're going to pay it directly to the contractor because they have certain guarantees to us as the lien holder on the mortgage.
Correct. They'll even have signatures required throughout the process. So you have your lender listed on the policy. They're going to have to sign off on checks. There's a lot behind the scenes. You definitely don't just get a check to do what you want.
Okay. Well, and that makes sense. I mean, there's more than just you being protected on it. It's protecting the lien holder. It's protecting the people that show up and fall on your steps because you didn't clear the ice, those types of things. So they're protecting everybody out there and making sure that the coverage is for everybody and it's done right.
Correct.
So let's talk about some of the other ancillary insurance products. Let's talk about life insurance. There's a big boom going on right now with COVID-19 in life insurance sales. So let's talk about, why would I go get a policy? You've known me for years. I'm the negative guy. Why would I pay for insurance that I don't get to use unless I'm dead? And then I really don't get to use it. But let's talk about why we have those policies and why we do those types of things.
Yeah. So obviously you buy a house. I'm coming to you, I buy my house. I just put a huge $300,000 debt on my family. I want to make sure I protect that. I'm not guaranteed to be here tomorrow. So if I just bought a house, I die tomorrow. How does my wife make that mortgage payment? Becomes a very important question. It's not anything that anybody ever wants to talk about because we all want to live to be 80, 90, 100 years old. But it's something we have to plan for. So it becomes, and there's specific policies designed. There's 10-year, 20-year, 30-year, a 30-year term policy would be a perfect policy to protect a 30-year mortgage. Obviously, if you put a 15-year mortgage in place, you could do a 20-year term. And there's just, it's important to make sure you have the right amount. So the birth of a child is going to be a reason to reevaluate your life insurance. Buying a house, definitely a reason to reevaluate your life insurance. Putting life insurance on children is actually, to me, one of the best things to do. And it's not for the death benefit of a child. It's the cash accumulation over a 60-year period that you can build for your child that they don't have to try and get qualified later in life. So we're not all guaranteed to get life insurance. I might go trying to get life insurance and they don't approve me. If I got life insurance when I was 2, they can't take that policy. So the insurability behind putting life insurance when we're young, healthy, everything's good is a really good thing.
Okay, so can you explain to us the difference between a term policy on life insurance and a whole life policy?
Definitely. So a term policy, you're locking a rate in for a specific amount of time. I have a 30-year mortgage. I want to pay $40 a month to protect my $300,000 mortgage. I get approved. I'm going to pay that $30 a month for the next 30 years. At the end of that 30 years, I was blessed, great, my house is paid off. The policy doesn't technically just go away. It becomes annually renewable. So that $30 a month can now go to $35, it can go to $70, it can go to $800. It's no longer locked in, but for that 30 years, it cannot change. On a whole life policy, it's going to have a cash, so it's going to have the pure rate of insurance. So it's going to have that $30 built in, but I'm going to throw an extra $200 into it. So I'm going to throw $230 into it. So $200 is going to go to a cash account. 30 is going to pay the pure cost of life insurance. Say I did this when I'm 30. When I'm 60, pure cost of life insurance is going to be $200 a month. I'm still going to be paying my $230, but I'm going to have built $200,000 of cash value. So at 80, now my pure cost of life insurance is $600 a month. I have enough cash value that policy just keeps feeding itself. I'm still paying $230. It takes some money out of the cash value, and it just keeps growing. If I want to borrow some money against it, I can borrow against my loan, my cash value. It gets kind of confusing, but I can take money. I can say I need a $5,000 loan, never pay it back. It's a tax-free loan to myself. So there's a lot of things you can do with the cash value later in life.
So would your advice be to look at whole life policies, which obviously cost a little more on a monthly basis than a term policy, or to just look at term? What would be the advice?
My advice is it really depends on the person's situation. So if I have $1,000 a month that I want to put at something, I can find ways to invest that. Still do a term policy, but invest the other money. If I'm looking at life insurance on a child, I'm going to do a whole life policy because there's enough time for it to grow that cash value. So I'm a fan of term insurance. When you're 25 and older, I'm a fan of term insurance because I don't see, unless I have a lot of extra money, I don't have enough time to build the cash value that I want to build. I'd rather throw it into a Roth IRA or something that I'm not going to have pure cost of insurance coming out of. So I'd rather see a 30-year term with a Roth IRA. The Roth IRA becomes my whole life policy than to have try and build a whole life policy for 30 years. It just the pure cost of life insurance grows too fast. So when you're in your 80s, it consumes that money too much.
All right.
It's easy, a lot easier if I had an illustration I showed you, but because I know it can be confusing, but it's
Yeah,
generally
absolutely.
something
But what I'm taking away from this is it's really going to depend on the situation and what your capability is to pay on that policy. Because life insurance is really a fringe insurance. And when I say fringe, what I mean is I'm required to have insurance on my house when I have a mortgage. I'm required to have insurance on my car. That's part of what I have to do. It's state mandated. But life insurance, I'm not required to. Nobody's saying that I have to have insurance in case I die that my family's taken care of. So it's more of I don't want to say boutique, but it's more of a fringe policy that's a choice I'm making in order to protect my family. It's not a mandated policy.
and that's why a lot of people don't have it, because we don't have to have it. I did not have it until I got in the insurance world, and I saw these stories of people dying that don't have it, and it's an amazing difference of a family that has somebody pass away that has life insurance versus doesn't have life insurance. I had a very close friend pass away. They could not put a tombstone on his grave because there was no money to do it. That's not what a family should be thinking about, worrying about when they just lost a loved one. So I've seen both sides of it. I'm a true believer in it. And it's the reason most people don't have it is because we don't have to.
Yeah, I mean, you and I are in unique situations. I mean, we way outpunted our coverages when it comes to our wives. You know, we way out of our leagues with who we married. So they're probably going to replace us the day after the funeral with someone that's got money and move on. So I'm not sure I want to protect her and make her more stable to help the new guy, but I do want to make sure the kids are taken care of. So insurance is the life insurance is a big part of that. So
And even to kind of to tone off that, for myself, I would much rather make sure that my family, if I was not here, my family is financially stable, so my wife doesn't have to go find somebody else.
yeah.
She has plenty of money and doesn't need to go and try and find somebody to bring into my family's life so that they can continue going on. And then my kids are being raised by another man because I didn't have enough financial support. So
Yeah, it's about making sure that they have the support that we provide, even when we're not here.
exactly.
You know, we're joking around about getting replaced, even though we know that's what's going to happen because,
Absolutely.
you know, but it's about making sure we have the coverage. So this is something you and I have talked about as I change directions here quite a bit. I'm a consummate entrepreneur. I think that everybody should quit their job and start their own business. Be your own boss and go out and work. And something that I've kind of tooled for my kids is the ability to help them start a business if they choose to. You know, and I think that whole life policies and Roth IRAs and stuff like that, I'm not a big college fund guy, but I think that setting up some type of savings with a cash value that they can go start that business without it hitting my pocketbook is something that should be done. So talk a little bit about the kids' whole life policies and how that cash value works and how they can do it in order to benefit them.
Absolutely. So I'll use my son Xavier as an example. I start a policy on him, $25 a month. It's flexible. So now I bumped it to 50 and then I went to 100. I'm not going to put more than $100 a month into the policy. He was 3 years old when I started it. He's 7 years old. He's 7 years old now. There's over $3,000 of cash value. It's going to keep growing. By the time he's 30, it's probably going to be $100,000, $200,000 of cash value. If he wants at that time, if I give him the policy and he wants to start a business, he could easily call up, take a $30,000 loan against that, never pay the $30,000 back, but exactly like you just said, he has some money there that has built over his lifetime that he can use to do that.
Oh, that's awesome. So it's basically a savings account for the kids that they can use, but it also has life insurance for them.
It's a savings account. It's growing tax free. They can take tax free loans against it, and it has a death benefit.
Oh, that is awesome. So let's shift gears and let's talk about how does your credit affect your insurance?
It is huge. At least I can't speak for every insurance company, but at least with Farmers, it has almost become credit is more important than how I drive, which is interesting to me. But I can have somebody that has, and I don't know people's credit. I just know what I see when I run a quote and I see full coverage on a Lamborghini for $60 a month, or I see full coverage on a Toyota Corolla for $300 a month. And that's all based on credit. So it's amazing to me. I know you do a lot with credit repair as far as with 700 credit. I want to dive into more of getting people to go to credit repair and rerun their score and see how much it improves their credit. But it is a huge factor. People always wonder, well, my aunt is insured with this same vehicle and she pays a lot less than me. It's not the insurance company. You got to look at your driving record and your credit score.
Yeah, so let's talk about the credit score a little bit, because on my side, I get an actual FICO score. I get 3 of them, one from each bureau, and we use a middle score. And then I see every trade line that's reported to the credit. So I have a very in-depth window into their financial background and what their ability to repay is. Now on your side, you don't get all that detail. You get more of is it a letter grade or a scale of 1 to 10?
Nothing. So I don't get to see anything on my side. LexisNexis is reported. So Expedia or one of them report to LexisNexis. That controls all of our scores. You can run your own report. You can do things, but our system just pulls from that report and gives you a rate. On that, I don't see anything other than your preferred, your standard, or your non-standard. Those 3 categories are the only thing I see. And I can't say a preferred is 800 credit score, 700. There's no way for me to know anything about it.
But it does give you some type of gauge to see where the price differences are.
Right. As soon as I see that preferred is just a PR with a green box, I know that person's going to get phenomenal rates. When I see that NS, non-standard, I know something's up with their credit. They're not going to get the rate that the preferred customer got.
Okay, so we talk about this all the time in my industry. You and I have had this conversation. I'm not sure the general public understands just how much their credit affects them on everything they do. So, whether it's credit card interest rates at 29% because you got bad credit, or it's car loans at 18%, or it's home loans at above market rate because of your credit, or not getting qualified on a home loan. It also affects your insurance rates. Your ability to pay those bills is being taken into account across the board. So insurance is one of those that drives me nuts, right? I pay a ton for medical insurance, which I don't hardly ever use, but I have it. Auto insurance, I feel like I pay a lot for auto insurance because I've got a 5th wheel and I've got 2 new cars and full coverage and everything. But I can adjust those by taking care of my credit. I can change the home and the auto by adjusting my credit and making my credit better.
Yes.
All right. So this is a huge shout out right now to 700 Credit Repair and Billy Alt. If Billy's watching, we're shouting you out, buddy. People need to talk to you. So here's the thing. Even if you have good credit and you're able to go finance things, there's probably things that are not accurate on your credit report that are affecting you and you just don't see it. So it's always good to have a professional look at your credit. It's always good to have a professional look at your insurance because I can't tell heads or tails when I look at it, but we've got to make sure that we're getting with the right people. And I always tell everybody, I could probably do surgery on myself, but I don't really think I want to, right? So I always, and I've been doing this for 24 years. I know how credit works. I know what can be done on it. I can give people advice on how to, here you go, this is what you can do to bring your scores up. But I always refer them to a professional. So let's talk about some of the additional coverages that may be on homes, or some of the things that people don't realize aren't covered, that may not be there, that could be an add-on. So me, I'm a big firearms guy. You and I have had this discussion on my policy several times. Explain to me jewelry, firearms, art, those types of things that
Absolutely.
are on the homeowner's policy, but maybe at a value higher than standard household stuff.
Yeah, so like we talked about before, you always want to make sure you have replacement costs on everything in your house, but insurance companies do protect themselves. So they don't want to find out that a house was burglarized and there's a $30,000 diamond, a $10,000 Rolex. So jewelry, cash, guns, business property, those are all things they're going to put a special limit on. Every insurance company is going to have a different dollar amount they set. And then they're going to offer you a jewelry floater, a gun floater, a camera floater. If you are a gun collector, I have to sit down and say, okay, Everett, let's go through your list of guns. You're going to have $5,000 of coverage on your regular home policy, but you have X amount of dollars. Let's raise that one special limit to make sure you're protected. So you can customize a policy within those categories. And that's usually what they are. It's going to be your fine arts. It's going to be your guitars. It's going to be your cameras. It's not your televisions, your furniture, your clothes. All that stuff is pretty much just put in personal property. But even the computers we're talking on right now, that's going to have a special limit. They're not just going to cover a $10,000 supercomputer that you built at your house. A lot of people think that's just covered, but there's going to be a special limit put on that computer, and you want to make sure that you're protected.
So we're looking at those type of floaters on more, I would say, appreciating items that are going to continue to hold value and go up. They're not going to depreciate. And that's your grandmother's diamond ring that's 1 carat that was passed down the family. Your firearms that continue to go up in value if they're maintained, art that's going to appreciate, those types of things that I think a lot of people think, oh, well, I have the insurance, I have coverage, and then they get robbed and they find out I just lost a ton of money because my grandmother's ring wasn't covered.
It happens all the time. And cash is another good example. People, they'll keep $5,000, $10,000 at their house in the safe, however they want to keep it, and it's just not covered in a home policy.
So the cash is not covered. Can I add a floater for having cash at home?
Not on a farmer's policy. You can get up to about $500 in coverage. That's about it.
All right. So here's the thing. Don't keep cash at home. Now, what about precious metals? Let's say that I'm the doomsday guy and I've bought 10 pounds of gold.
Going to be the same as cash. It falls in the same category.
All right. So it's better to put it in a mason jar and bury it in the backyard where nobody knows where it is than to leave it in the house where it can be robbed.
Safety deposit boxes, things that, there's definitely ways to protect it, but not your home insurance.
Okay. So let's talk about, I buy a new house, I'm in it 6 months, and the sewer line from the house to the city hookup, it just goes out. A tree root's busted it. It's bad. I now can't use my bathrooms or anything like that. So how does insurance work on that?
Yeah, so insurance is designed for that one-time occurrence. It is designed for in damage to the actual house. So it's not designed for that tree root that just over time grew, wrapped itself around a drain, and now all of a sudden you're having an issue. So Farmers is actually just in October released Service Line. It's a new coverage that would cover exactly that scenario. So the insurance policies, they're growing. They're starting to help a little bit with service and maintaining a house, but they're generally designed for that lightning strike, that hail strike, that theft, that fire, that one-time occurrence, that sudden burst. You went away for the weekend, the washer line broke, you come home and your house is just flooded with water. That just sudden burst of water. All of those, like we did on your mom's house. It was a great. I used the claim a lot in examples because you guys it worked out great. But it was just that one-time occurrence. Now, if that would have been just a slow leak behind a wall that we didn't know about for 6, 7, 8 months, those are things that aren't covered. It was a long-term maintenance related thing. So it's a fine line between what is and what isn't covered. And that's why you get a lot of people that aren't happy with insurance. They just think they have home insurance and it's going to cover everything. And it's just not the case.
So basically what we need to do is educate ourselves on what our coverage is and make sure that we know what it's going to cover so that we don't end up disappointed or mad at our insurance agent because they didn't tell us.
True.
So we need to educate ourselves on what it is. But Service Line sounds great that it's going to cover some of that maintenance things. And I think the whole term maintenance is something that people need to understand. When you sign a mortgage, inside the mortgage or the deed of trust on that, it states that you're going to maintain the home. You're going to keep it in good working order. You're going to make sure the roof doesn't leak. You're going to make sure that the walls aren't falling down. You're going to maintain that collateral so that it's still good collateral on the loan. And that carries over into insurance. Maintenance on the home, the upkeep on the home is whose responsibility?
The homeowners. That is the number one reason claims get denied is people think the insurance company is going to maintain the house. It's our job as a homeowner to maintain the roof, to maintain that little leak that you don't want to deal with. I mean, all those little maintenance related issues is why we own a house. We have to maintain our houses. Then the claims adjuster can come in and say, hey, you did a good job maintaining your house. Yes, the wind blew your shingles off. You have a leak. Those shingles were in good condition. Thank you. Sorry this happened. And we cover the claim.
Awesome. So I had that happen to me a couple of years ago. Farmers was awesome about it. Claim adjuster came out, looked at everything. She's like, wow, this is really terrible. And within 3 to 5 days, I had a check to fix the house.
Oh, yep.
And those are there because my roof was destroyed, missing shingles all over, and we had major water leak from the storm during it. And it was an inconvenience, to say the least, on us living in the home. But Farmers bailed right in as soon as we filed the claim. So I want to talk about the customer service side because you do some things different than a lot of insurance agents I know. And this is one of the reasons why we started using you as our insurance guy. Let's talk about how you look at policies. Do you do an annual review? What are you looking at? Because I know that policies change from Farmers all the time. Coverages change, those types of things. And you can use my mom as an example. When I sent her over to you, she was with Farmers, but her policy was from 1996, was the coverage that was in 96. So talk about that and what you do for your customers.
Yeah, so it's one of those things that just when I started my business, I wasn't from the insurance world. I'm not a salesman. So the money side of it, I just had, I guess, a different outlook. I'd rather provide somebody the coverage. So your mom, for example, she was paying $1,400 a year on an old policy. We moved over to the new policy. You transferred to my agency. We moved it to the new policy, put better coverage in place for like $780 a year. So I know we saved her about $700. To me, it cost me about $70. So the way a commission works, I can take $70 out of a year's commission to save your mom $700 and give her better coverage. So we've just designed our agency around coverage, not money. And it's come back twofold because those people refer more people to us. We get to give better coverage, and we have a lot more customers that just pay a lower amount. So the money all works out. But the bottom line is I get to review every policy, make sure you're getting the best coverage, the best rate with Farmers, put all the discounts in place so that you're getting the most for your money and it doesn't affect me at all.
So what you're saying is you're paid off of the policy amount, what they pay in fees, right? In premium. You're paid off of that. So if it's $1,400 and it goes to $700, you're losing $70 in commission on that deal. So you're saying you go in and review all your policies to make sure that they've got the best coverage at the lowest possible rate, even if it costs you money.
100%, yes.
Okay. So you're giving up money on your side to make sure your customers are taken care of and have the best coverage and payment that they can have.
Any chance I can.
I think that's outstanding. We live in a world where, especially on the commission side, it's all about getting the commission because we have bills to pay. We have families to take care of. And what you're doing, I think, and I keep saying this on all the ones I'm on, David Kaywood said it the best that I've heard. David said, I'm not worried about the commission on the deal I'm working on. I'm worried about the commission on the deals they're going to refer to me. So I do whatever it is I have to make sure that they're taken care of and that I get them the best deal and that I give them the best customer service and that they're taken care of so that they refer me their brother, their cousin, their sister, their aunt, their friend, all of those. That's where the payoff is. It's a long-term game on that. So
yeah, we've been doing it 14 years that way. Everybody in my agency has been trained that way. And I love to hear them make that same phone call. And they could have a rate locked in and all of a sudden Farmers has something new and they're calling that person to say, hey, Farmers just released something. We're going to change you over to this and it's going to save you $200. And they're taking commission out of their own pocket based on philosophy. And it's been great.
Yeah, I think it's amazing because what we see, and this is what I see, is companies that are doing the right thing, that are taking care of their customers, tend to last longer, be more successful, they grow faster because we take it out of it being about us, which ultimately you're in business for you. You're ultimately there so that you can pay your bills, support your family, do what you want to do. But when it's not about you and it's about the customers, that customer base grows.
True, 100%. I've noticed it the last 14 years, and I'll never change my business model.
Yeah, and I'm going to go back and tell the story. James used to rent an office space in the building we were in that Steve owned at the time. And I was literally walking by his office one day, listening to him call clients and go, hey, we just got a new policy out. I can save you another $200 on your policy. I'm going to go ahead and implement that. Coverage is the same, all of that, but it's going to save you money. And I literally, I can't remember, I was with State Farm or Allstate or somebody at that time. But you got off the phone and I walked in and I said, so is that just something Farmers does? You know, they call them, and your answer was no, but I think that I need to take care of my customers. And so I review it all the time. And I think it took me another 5 minutes to bring in all of my policies and say, quote this, because I was astounded. And I literally sat there going, why has my insurance agent never called me? I've never heard from them from after I set up my policies with them. Why are they not calling me to talk to me about it? So I'm astounded. I want to commend you for that. I think it's great business model and it does a wonderful thing. So if you could leave everybody with one bit of advice on insurance, what would it be?
Simply for me, keep it out of the 800 number hands. We all have a family doctor. We all have a family dentist. It's one of those things that we go through a ton of training. Every insurance agent out there has to be licensed. It's not something that you should be able to just go online, pick what you want, look at a price, and hit submit. Same as I shouldn't be able to go Google what I think is wrong with my leg and order medicine online. You want to have a professional look at it. I stress that more than anything because I see the Progressives, the Geicos, let me just click this. Oh, wait, this price looks better. They click it and the person leaves my agency. And 3 years later, I get them back because half the stuff they thought they had wasn't covered. And now they're not happy and they're stuck in a bad situation. Please do not shop by price and please use an agent.
Yeah, I mean, if you're hurt, you call a doctor. You get a professional opinion. I tell everybody I grew up on a ranch. I can do quite a bit turning a wrench on an engine and stuff like that, but my truck goes to a mechanic. Exactly. I take my truck to the mechanic. You know, those types of things. And I go back to credit. I've got 24 years doing this. I know credit really well, but even if it's my own, I go to an expert to have that fixed. So make sure that you know who you're dealing with. Make sure that you're getting what you're expecting. I can't stress this enough. It's something I tell everybody. Ask the questions. Ask the questions. Even if you're to the point of being annoying, ask the questions. I have clients that do it with me all the time, and my goal is to make sure they know more about mortgages when they close than they ever wanted to. But ask the questions, be annoying, make sure you're getting the answers, because if you're not, you need to look for a professional that's going to be able to answer those for you and help you out. So, James, I want to thank you for being on with us today. This is some wonderful information. So, you guys can find James on Facebook, James R. Delmore on Facebook. You can look him up, send him a message. James, give us a website, give us a contact phone number so that people can reach out to you.
Yeah, so our office number is 505-792-6367. Email jdelmore@farmersagent.com.
Awesome. Well, we certainly appreciate it. Tell your lovely wife and those beautiful kids that we said hi, and thanks for letting you sneak away in quarantine. I got to be honest with you. They were amazing. I think Sarah has them locked in the closet. I saw nobody walk behind you. I saw no details. But thank you for being on today. We really appreciate it.
Thank you, sir.
All right. We will talk to you later.